Sorry, I just got a messed up something. I just need to rejoin my meeting here. Go. Guys, so welcome. So what we're going to be doing is I'm going to be taking you through some of the finance, but in a slightly different way. So we're first going to talk around business in general and maybe your thought process around what is business and business acumen, about understanding business. Then I'm going to introduce you, for those of you who don't understand, a little bit around income statements and balance sheets, but how they fit together. What are they? In a very different way than what hopefully you've seen it before, but hopefully it's in a way that will explain exactly what it is and how it's used. And then I'll take you through just the income statement. And then we'll look at a couple of calculations about what you could be looking at. And you should definitely be looking at some things related to your business. So from a numbers point of view. So let's get into it. And what I'm going to do, instead of me trying to explain things, I'm going to play you, as we go along, a recording of a pre-recorded lecture that I gave so that we can see it, and it's got a little bit of animations in it, maybe makes it a little bit easier. And then at the end, I'm going to open it up to questions. So if any of you got any questions around what I discussed, but also around your own business, if there's some specific questions you want to know, I'll open it up and hopefully I can answer as many of those as we can. We're looking at the session to run, I know it was listed for 2 hours, but most probably around an hour and a half. So hopefully we'll get done by around about 11:30 we should be done. Okay. So the question is this. Let me ask you a question. What does this say? When you see this, can anybody tell me, and you can unmute yourself and just say, what do you read when you see this? Anyone?
Information nowhere.
Correct. Well done. Information nowhere. Did anyone read anything else, sir?
Information now here.
Ah, fantastic. Information now here. And the question is, what is correct? Information now here or information nowhere? And the truth is that they are both correct and both exist at the same time. And this links very much to your finances. A lot of people who are scared of numbers will have a look at will get reports, and for them there's information nowhere. There's no information, that doesn't make any sense for them. Somebody else can look at these numbers and it makes complete sense of their business. They don't really have to see the business. They look at the numbers and they understand it. So I'm going to hopefully move you a little bit from the nowhere to the now here to be able to understand what the numbers are telling you and maybe what numbers you should be looking at. We look at it generally, and we're looking at not just so that you understand income statements and balance sheets, but we look at it so that you get an overall understanding of business. And when we talk about business acumen, we're really talking about understanding how a company makes money, what you should be doing to making money, and how to think in that way and make those kind of decisions. Okay, so hopefully I'll explain income statement, balance sheets, but it's within the broader spectrum that you can use this to make more successful business decisions. Just as a question, here's a picture of two people. Anybody recognize who those two people are? And while you're looking at that, I put this up on a presentation once, and somebody said to me, that looks like the young you and the old you. Well, it is the young me. And the young me is with a guy called Stephen Covey. And if you've heard of Stephen Covey, he's the guy who wrote a book called The 7 Habits of Highly Effective People. A very, very good book to read if you get the opportunity. My book, I've been lucky, as Tracy mentioned the book earlier, it's sold something like 22,000 copies, which sounds great until you compare it to his. And his book has sold over 15 million copies. Okay. And why would I put that picture up? And some of you must probably think to show off, and it's not to show off. Stephen Covey says this. This is how you learn. When you pick up a book and you read it, even if you understand everything that you've read, you've still only got 10% of the knowledge. It's when you hear and see other people use it, that's where you gain more knowledge. It's when you are now immersing in it yourself by experiencing it and discussing it, that's where you learn even more. So a lot of these things you can sit back and you can listen to it, but it's by trying to use it that you learn, and you learn more about it, and it makes more sense to you. So my suggestion to you is anything that you take today, try and implement it. And even if you're not using it exactly, you'll still be learning from it. So when I met with Stephen Covey, we swapped books, and I came home one day, and this was written in the book. David, thanks for your book. And then it had a whole lot of other stuff, and I couldn't read what it said. So in fact, my mom-in-law saw the book and asked me what it said, and I said, I don't know what it is. And she wrote to their offices in America, and we got this reply back. David, thanks for your book. You're a trim tab. And then she said to me, but what's a trim tab? And I had to admit I didn't know. So we wrote back to them and said, what's a trim tab? We got this answer. It's a small rudder that moves the big rudder that moves the entire ship. And I think they were trying to sell the next book called The Eighth Habit, because they said there's a whole thing on it on page 32. But what is that? And here's the story. That when a captain is at a ship and he's trying to move the wheel, there's too much pressure against the wheel. And it's around, you have to move the little rudder, which you can, there's less pressure, and that'll move the bigger rudder, and that eventually moves the entire ship. And the lesson behind this is it's the small change in the trim tab that'll make the giant ocean liner change course. It's the little things in life that have the big impact. You know, we often want to make a big impact. It's a culmination of all the little things that eventually has that big impact. And so always think when you're looking at a business, your result is a big change, but what are the little things that I can put in place that can make this big impact? And another quote I'm just going to bring in here, which I really like related to water, is you don't drown by falling in the water. You drown by not swimming once you've fallen in the water. We are all going to make mistakes. We are all going to fall in the water, so-called, but it's what you do from then onwards. And that's about swimming and trying to make an effort to get out of that. So always try improve. Try and improve with those little things. It's the little things that have the big impact. I want to give you just a little example, for instance. So here's a businessman who's trying to sell a watermelon. And the watermelon costs €1, and he can then sell it for €1.50. So he buys it for €1, sells it for €1.50. Can you tell me, maybe some of you can unmute and just jump in with your thoughts here. Why or how can he charge €1.50 when he pays €1? Why would somebody pay him more for the watermelon than he himself paid for it? Anybody want to hazard a guess?
Convenience.
Okay, Jody, just give me a little bit more around convenience.
Well, if I live in Shoreditch and I just have to go around the corner to buy a watermelon, that's going to save me a whole lot of time, and it's also going to save me petrol.
Absolutely.
So I would be willing to pay the €1.50 for that watermelon.
Absolutely. So it's from a convenience point of view. And in this particular case, the convenience is maybe the location. It's stopping me from having to travel somewhere, as you said. The convenience might be even more. The convenience might be that you now just want a quarter of the watermelon or half the watermelon, and so he's willing to slice it for you. That gives you more of that convenience. Okay. So this is how generally a businessman would look at it. An entrepreneur would look at it slightly different. An entrepreneur would take this and would buy a watermelon, but would sell something that's more than just the watermelon. And it could be something like this. He could be taking the watermelon and turning it into watermelon juice. Okay. And now he can charge instead of €1, or instead of €1.50, he can now charge €5. And he's changed the format completely. How does this relate to you and your businesses? Depending on your business, are you able to take a commodity and convert that commodity into something else that is more and bigger than what the product is that you originally got? And in this particular case, you've got this beautiful glass with the watermelon juice and the little umbrella in the top. And if I said to you, does that umbrella change the taste of the watermelon? You're going to tell me, obviously not. How can the umbrella change the taste? But here's the thing. By giving it into putting it in a beautiful glass with a little umbrella, you have that feel-good factor. And you might not be changing the taste of the juice, but you're changing the taster of the juice. In other words, you're changing the way the person feels when they're drinking. If I served you this in this beautiful glass, you'll feel better about it and better about yourself than if I gave you into a crushed up little paper cup which was dirty, etc. So I think it's Maya Angelou who said, people might forget what you said, but they'll never forget how you made them feel. And the message I'm giving you with this is, no matter what business you're in, how can you make your customer or the person you're dealing with feel better about themselves when they're doing business with you? What is that extra little thing that you can do that doesn't cost you too much? When I say cost, either physical cost or from an effort point of view, but makes it different, makes them feel like they are valued. And no matter what you're selling, you need to find that in university terms, if you're doing an MBA, they call it a USP, a unique selling point. What is your unique selling point? What is that extra that you're putting in? Try and find something that the way that you do it makes that person feel special. A small crazy example is even Apple. If you buy a new Apple product, you get it in this box. When you try and open the box, it takes time for it to come down. Do you know that they've worked it and they designed it specially like that? It takes 7 seconds for that box to open. And for them, they did that because they wanted almost like a great reveal. As you open the box, it takes time to show itself. You don't just rip the box open. And that's kind of a little bit on the gimmick side, but it also works. How can you present it in a different way? Okay. So this is just a little bit of background to that. What I'm really going to be covering today is the understanding of the income statement. I'll go through a couple of ratios, and then we'll discuss what's a financial dashboard and how can you use it for your benefit. But before we get there, here we have a couple of people playing soccer. And if you watched some people playing soccer, how do you know if they are winning, or how do you know who is winning? You see two teams playing. Anybody know, or just tell me, how do you know who's winning the game? Anybody want to jump in with a comment, yeah?
Who has the most goals?
Correct. And how do you know who has the most goals?
You look at the scoreboard.
Correct. You look at the scoreboard. You need a scoreboard to know who's winning. How often are we in business and we don't know if we're winning because we don't have a scoreboard? And what is the business scoreboard? The business scoreboard are the financial statements. Your income statement and your balance sheet, those are your scoreboard. So you have to use those in order to see if you're winning or losing. So I'm going to take you through now a couple of videos. And these videos are just one explaining now what's an income statement balance sheet. So if you didn't understand income statement balance sheet, it'll show you how it links together. And then I'll take you through just specifically the income statement and what you need to look at with that. So I'm just going to change over here quickly just to the videos. And I just need to find it now. Here we go. So I'm going to pull in that one, and this, I'm going to show you this one first. And this one is going to be showing you the income statement and balance sheet. Let me just get there quickly. Sorry guys, there's just been, I've just shut the wrong thing down here. Let's go here. Great. Hopefully you can see this. Can I just get a quick yes or no? You can. Okay.
Yes, David, thank you.
Right. So I'm going to talk now just the income statement and balance sheet, how they link together so that you know how to use the so-called scoreboard. And I say you need to use accounting to manage like a pilot. What do you think I would mean by that? Maybe this picture can help you. So here's a picture of a dashboard in an aeroplane, and a pilot is sitting in front of the dashboard and it has all those dials in front of him. The pilot can have a look at any of these dials and understand what's happening in the rest of the aeroplane. He does not have to get up and walk to the back of the aeroplane to see what is happening. All the information is fed to him in one place. And as you can see, some of these dials have a little bit of red and a little bit of green. And if you look at the green bit, if the dial is in the green bit, it's positive. If it's in the red bit, there's something wrong. As people in management, we need to create our own form of dashboard. And in fact, we call it a financial dashboard. And it indicates to us what's happening within the business and what is good and what is bad. So you need to decide what you're going to put on those dashboards. When a pilot gets into an airplane, the dashboard's there for him. When we get into business, we can decide which are the things we're going to focus on. What are those numbers that we focus on? And as someone said, what gets monitored gets done. And you need to decide, what are you going to monitor so that it gets done? And you decide what those indicators are, and also decide what the traffic lights are, if it's red, green, or amber, if it's good, bad, or not so good. So you need to learn to manage like a pilot. There's some important concepts that we'll go over. We might have mentioned this in a previous video, but GARP and IFRS. We used to report accounting according to GARP, General Accepted Accounting Principles. We now report according to IFRS, International Financial Reporting Standards. These are just different ways of reporting the finances and have their own rules and their own layouts. The way the balance sheet used to be laid out according to GARP is slightly different according to IFRS. During this course, I'll highlight some of those differences. We've also got the matching principle, which is a very important thing, and it relates to depreciation, which we will get to and discuss later on. But what the matching principle says is that you need to match your income and expenses to the period in which they're being used. In other words, if I pay for something today, but it's a payment that's going to last over 5 years, I need to split that payment over the 5 years. Double entry is so crucial to finance. The double entry bookkeeping system. Every single transaction has two sides, the in and the out. If I bought a car, I might go to my friend and say, hey, I bought a new car. I'm only giving half the transaction. What I should do according to accounting is say, well, car in, but money out. And the double entry bookkeeping system uses this concept throughout to make sure that we balance at the end. Now, accounting has its own language, and this is one of the limitations, one of the big limitations. We use terms that you do not understand. So you need to learn to speak Accountanese, if you want to call it, the language of accounting. Also, you have terms that actually sound like English, but are not, like turnover. Turnover in English means one thing, in accounting it means something else. And in fact, we have different terms that mean similar things, like turnover, sales, income, revenue. So we're going to, during this course, unpack all of those things so it becomes a language that you understand. Another limitation is that accounting can't show non-monetary information. If you've got something that you can't reduce down to rands and cents, you can't put it into the balance sheet, like potential, like opportunity. Cannot put that down in the balance sheet. And then value shown is not necessarily today's value. Figures are approximations and may reflect opinions. Sometimes we have something that is worth something and it's written in our books at a certain value, and we know that at the market we can either get a lot more for it or a lot less than for it. So the value shown is not necessarily what the market value is, because we're using the accounts for a different purpose than for the market value. And again, we'll unpack some of those. So if these are the limitations, you might say, well, why do we need accounting? Because we use accounting to produce some vital information. We measure the amount and source of profit or loss, how much we made, and where we made it within the business. And was it a profit or was it a loss? We show the cash flow generated in the source, how much cash was actually generated and from where. Cash is different from profit. Do you know that you can make a profit and still go bankrupt? And you think, how can you make a profit and go bankrupt? And it's because of a timing difference. When I make a sale, we record it as income. But if I only get paid for it later, I don't have that cash flow. And if I get paid too late, then I run out of cash. And then we got the capital employed in the business. That's how much money has been invested in the business. And we record who owes us and how much, and who we owe and how much. Finance also gives us direction. When we're planning for something, how much do we need? How are we going to allocate our resources? Where are we now? Where are we going? What's our current status, etc.? So we use finance as the overlaying layer of the whole of the business. And now what I'm going to do is a little exercise with you. And I'm going to simulate something that would happen in a face-to-face classroom. In a face-to-face classroom, I'd put this up and then I'd start asking questions and people would shout out the answers and I'd write them up. So I'm going to simulate this as best as I can. And I'm saying, we're starting a business. Where would you get money from to start a business? And you could say you get a loan. You get money lent to you from a bank. And then I'd say, where else could you get the money? Maybe you put your own money in. Not a bad idea. Where else? Investors. Yes, you can get a whole lot of investors. And the investor could put some money in. Is there anywhere else? We've got something called the 3 Fs. The 3 Fs, if you haven't heard of it, stands for friends, family, and fools. And it's just a term, I'm not sure where it came from, but it's a term that is used that means everyone else. Where did your money come from? Well, everyone else, the rest of that, kind of it encompasses everyone else. And the last place you could potentially get money from is government. So you could get all sorts of funding, but the funding you get could be from these 5 main groupings. So we got some money. Now, what do you do with that money? Where do you invest it? What do you use it for? And again, people could shout out answers, and I'm assuming somebody would say buildings. And so, yes, you could use some of that money to buy buildings. You might not want to buy the building. You might want to rent it. What else could you use the money for? A car. And if you buy a car, you'd have to put petrol in it. So we record that as well. What else? Salaries. We've got to pay salaries. We might pay for some marketing. We definitely have to buy some stock for our business so that we could sell it. Buy some equipment that we need. Pay for maintenance. Pay a variety of fees. You might have lawyers' fees or accounting fees. We might have to buy some computers. So you are buying and doing all these things. So as we're going through this, these are the things that you might have called out. And then hopefully I make some sales. And now as you called them out, I wrote some of them over here and others I wrote over here. What was the difference? Why did I write some of them over here and some of them over here? What is the key difference between those two? And if you think of it, these things over here are things that I own and they got a value attached to them. I buy them, I use them, but even though I use them, they're worth something. The things over here are things that I buy and I pay for them and I use them, but as I use them, they get consumed up, they get used. So the things that I buy that have got a value attached to them, these we call assets. And the definition of an asset is just something that you own that's got value attached to it. What are these things, these other things that we pay for and they get used up? Those we call expenses. And ourselves, what do we call that? Well, that's money coming in, income. And this over here, where our money came from, well, those we call liabilities. And some people say to me, hang on a second, how can those be liabilities? In there is our own money. How can that be a liability? It's because you and the business are complete separate entities. If I own the business, but I take my money and I put it in the business, because it's a separate entity, even if it's owned by me, the business still owes it back to me. So I take my money and I put it in the business. If I look at it from the business's point of view, from their viewpoint, they owe this money back to where it came from, which is me. And so if we look at your income statement and you take your sales, less all your expenses, you could land up with a profit. If your sales are more than your expenses, you make a profit. But if your expenses are more than your sales, you can make a loss. And this, in fact, used to be called the profit or loss statement or the P&L. So this whole thing is your income statement. This is what we call the income statement today. And the other side, your assets need to equal your liabilities, because we say where the money comes from and where the money goes to. And these two things have to equal. And when things equal, we say they're in balance. And that is why this whole thing is called the balance sheet. So that's your income statement and that's your balance sheet. Your income statement just says where did the money come from in terms of sales and what expenses did we have? And if we're getting more income than expenses, we make a profit. More expenses than income, we make a loss. And your balance sheet tells you where did my money come from and where does it go to. And those two things equal. As you've seen already from the previous videos, the income statement has a new name under IFRS. It's called Statement of Comprehensive Income. Well, I'm just going to continue calling it the income statement. And your balance sheet also has a new name. As you've seen, it's called the Statement of Financial Position. But I'll most probably continue referring to it as the balance sheet. Now that you're okay with... Okay, guys, so just before I continue, I just want to emphasize this. So the one thing is the income statement and the other is the balance sheet. And these are the key documents that one looks at, as we mentioned before, the scorecard. I'm going to explain this now using numbers that'll make it a little bit easier, but I just want to find out any questions before I move on to the second bit of this. Okay, so I'm going to do exactly what I've done here, but with numbers, so maybe you can see how they link together, and then I'll open it up. You might have some questions then. It's called the Statement of Financial Position, but I'll most probably continue referring to it as the balance sheet. Now that you're okay with that, I'm going to go through this exact same exercise now, but I'm going to put numbers to it So let's have a look at this in terms of starting a business. So I'm putting numbers to the previous information. Maybe we can understand it a little bit more. You want to start a business. Where can you get your money from? You go to a bank and they give you some. So let's say the bank gives you 100. Where else can you get money from? So you get some investors and they give you 100. And so now we have 200. On day one, where's that money sitting? Yep, it's sitting in cash or in our bank as an asset of 200. And our balance sheet balances. Now we need to buy some equipment. So we buy equipment of 100. Where does that money come from? It comes from your cash. And your balance sheet still balances. We might need a car. So we now get 50. We take 50 for a car. Where do we get that from? Also from our cash. Your balance sheet still balances. We now take some of this and we pay for salaries. And let's say the salaries was 35. Where does that money come from? Yep, from the cash. So now our cash is down to 15. And if we look at this side of the balance sheet, on the asset side of the balance sheet, it now adds up to 165. And your balance sheet doesn't balance. Your balance sheet goes out of balance. It's an unbalanced sheet. But don't worry about it now, because at the end of the period, we rebalance the balance sheet. Let's say that now we make some sales. And our sales are 60. Part of that 60, people pay us in cash. So they pay us 20 in cash. So our cash now goes up to 35. The rest they owe us. And what they owe us is the remaining 40. And we call that debtors. Debtors is money that is owing to us. It's not debt, it's debtors. They're different. We're going to talk about debt in a second. And now if I look at my balance sheet and I add it up, it still doesn't balance. If I add up all these, 35 plus 100 plus 50 plus 40, that comes to 225. And now the balance sheet is unbalanced. It was unbalanced the one way, now it's unbalanced the other way. But here's the trick, and this is an important trick to understand within this. At the end of the period, we look at our income statement, and we take our income, in this case 60, less our expenses, 35, and we get a profit, 60 minus the 35 is 25. Who does that money belong to? That belongs to the investors. And we take that money and we could pay it back directly to them in dividends. But if we are a growing business, we take that money and we give it back to them directly. And so this now becomes 125. And we add these two things up and it's 225. And now our balance sheet balances. So hopefully this is showing you the mechanism of how this works. And by the way, money that is lent to the business and you pay interest on it, that type of money is called debt. So instead of bank, I'm going to write debt. And money from investors is money that's put into the business. And they don't earn interest, they share in the profits, and that's called equity. And so what we've got now is we've got our debt and equity adding 225, where the money came from. And the other side of the balance sheet, all our assets, and that equals 225. And our balance sheet balances. Just by the way, the assets that we've got here can be split into two types of assets. We got current assets, which is your short-term assets. Your current assets are short-term. And in finance, when we talk about short-term, we mean anything below a year. That would be short-term. And our other assets, which are longer than a year, are non-current assets. So guys, I'm going to leave it there. The non-current assets previously used to be called the fixed assets, if you've heard of anything like this. So this is just to explain, you got the two documents. We generally focus on the income statement as smaller businesses. We don't normally worry about the balance sheet so much. But it's very important that you understand the documents. And as you grow, you need to keep aware of these things. And your profits need to be as a percentage of what you've invested in the business. I'm going to open up to a couple of questions, and then I'm going to show you a separate video just looking at the income statement specifically, and then we'll go into more detail. But any questions so far? Any comments with this?
Nothing in the chat, David.
Nothing in the chat. Okay. So let me move on to just looking at the income statement specifically so you understand that, and then we'll look at some of the ratios. I'm going to start off just showing you the overall picture of the accounting reporting structure, and then talking specifically income statement. Explain the whole accounting reporting structure. We start off with what we call business transaction documents. These are invoices, good delivery notes. These are things that show that a transaction has actually occurred, because you can't record it until it's actually happened. We take these transactions and we record them in the books of prime entry. This is where we do your journal entries. And a journal entry is just where you debit something and you credit something else. All that means is you add it to the one thing and you take it away from the other thing. The big concept within accounting is what we call the double entry bookkeeping system. Every transaction has two sides. So you debit something and you credit something else. For this course particularly, we're not going to get into debits and credits. That's like getting into the mechanics of something. That's like trying to understand how the engine of your car works when all you're trying to do is drive the car. So we're teaching you how to drive the car, not become the mechanic. But now they take the books of prime entry, and then we register it in the general ledger. And the general ledger puts it into the different categories. And then we link it to a trial balance. And the trial balance is to see that it does balance. And we move some of it to the income statement and some of it to the balance sheet. And you should understand that by now. From the previous video, what do we put into the income statement? Well, anything that's an income or an expense goes to the income statement. Anything that's an asset or liability goes to the balance sheet. And then we take that and we create the cash flow statement from that just to see what is cash, because some transactions are not cash transactions. So you can make a sale, but it might not be cash yet. And then we analyze this whole thing using ratios, and that will go through at a later stage, the different ratios. And that's unpacking it to see what's one thing divided by another, just to see what the implications are. And then we use that analysis to look forward and start forecasting something for the business. So that's kind of the overview of it. But let's get into the nuts and the bolts of the income statement. So the income statement is intended to show the sales, the costs, and the profit made over a period of time. And therefore, it's got the words always for the period or from one date to another date. Your income statement shows you a flow over time. On the other hand, your balance sheet will always be the balance as at or on a particular date. But your income statement is what did we make over the last week, month, year? So here's an illustration of an income statement. For the year ended, it's still the end of the year. And then these numbers are in thousands of rands, and you can see you've got your revenue less your cost of sales gives you gross profit, less your operating expenses. That operating expense of a 946 is made up of all those other expenses taken together and added up. Then you land up with what we call the operating profit, less interest. You have your earnings before tax. You take off your tax and you're left with your earnings after tax. That's what we term the bottom line. When people talk about the bottom line, your earnings after tax. I just want to go back briefly to that cost of sales. This over here. The cost of sales in a stock environment, just so that you understand, is made up of opening stock plus purchases minus your closing stock. It means we came into the business with some stock that we wanted to sell. We're buying some more. And then what we didn't sell, when you subtract your closing stock, that's your cost of sales number. And you can see when we look at this income statement that we're starting at 7,400, but we only land up with 1,100 in round numbers. And a very important thing about this is that a lot of people, when you ask them how they're doing, they say, fantastic, my turnover is 7,000. But that's the top line. What you leave with is only the bottom line. And there's a saying in finance, they say turnover is vanity. If you ask somebody about their business and all they talk about is the turnover, the top line, that's vanity, that's showing off. Profit is sanity. That's where you're looking at the profit. But cash is reality. And we say cash is reality because you can still have this profit over here of 1,166 and still go bankrupt if that money, if that cash is not in your pocket. So the cash flow is like the air that you need to breathe. And you can have big muscles, but if you don't get air, you can die. And the same with a business. And here you've got your income statement. And let's unpack this in a little bit more detail. So if we look at what we've just discussed, and I look at it as a picture, this is exactly what it is. Here you've got your sales, this big amount over here, but you've got to take off your cost of sales. You're left with your gross profit. Then you take off your expenses, you're left with your operating profit. You take off your interest, you're left with net profit before tax. Then you take off your tax, etc., etc. And you can see how that yellow portion becomes smaller and smaller. And that's what you're left with at the end of the day. Your net profit after tax, and then you can decide how much you want to give to shareholders and how much you want to retain in the business. And a question I often get is, why would we do this? Why would you have all these subtotals? Why don't we just say sales, net profit? Why have all these other yellow pieces in between? Surely that complicates it. And the answer is no, it doesn't complicate it. It actually explains it. We have these subtotals for analysis purposes so that we can analyze it and see what's in each slice as we go ahead. You know, if you got an apple and you think there's a worm in the apple, well, you'll cut it in half and you'll see, is it in this half or this half? And you might still not see it. So then you cut it thinner and thinner and thinner. And the more thinner each slice is, the more that you can see that is in each of those slices. And that's why we do it, for analysis purposes. By the way, a few years ago, I heard a story. What's worse than finding a worm in your apple? And the answer is half a worm. Not 2 worms, half a worm. Because if you find half a worm in your apple, you are no longer a vegetarian. Anyway, so here we go back to your income statement. And here's another picture of it. So let's say you get this bottle of wine, and that's your sales. And you want to go drink this wine. But before you can drink it, you got to pour it into this funnel. And unfortunately, the funnel has holes in it. And as you pour it, the wine leaks out. And part of the leakage is your cost of sales, the cost of the product in order to get those sales. Then you've got expenses, other costs that you have to incur to get those sales. And then you've got to pay taxes. And then you land up with your profit. And your profit isn't the whole bottle of wine. Your profit is just this little drop over here. And this is kind of what explains the income statement, where you start off with a whole big bottle of wine and you land up with a little bit of profit at the end. So your income statement starts off with your sales. And then you take off your cost of sales and you're left with your gross profit. And you take off your expenses and you're left with your profit before interest and tax. And you take off your interest and you're left with profit before tax. And you take off your tax and you're left with profit after tax. And then if you pay dividends, that little bit is what you're left with, your retained earnings. So always think of this like a funnel that gets smaller and smaller and smaller as you get along. And now you've got your first... Okay, so we're not going to go through any exercise with this. I just want to... I'm going to stop sharing for a second. So I just wanted to give you that explanation of it. Any comments or questions? Anyone want to understand something related to their business with this?
No
Yonette.
comments, Dave.
Yes, I can see Yonette's got her hand up. Normally, if I get no comments,
I don't see that.
it normally means that people have understood everything or they got no idea what I'm talking about. So, Yonette, yes, your question.
Hi. Firstly, thank you so much. Secondly, I wanted to just ask, can you please go over the cost of sales thing?
Okay. So, in terms of your opening stock, that calculation.
Yeah, how do you calculate the cost of sales?
Okay, so just as an overall understanding, your cost of sales is the cost of the product that you're selling. That's all it is. So if I'm selling a watch and it costs me 500 Rand and I'm selling it for 800 Rand, my sales is 800, my cost is 500. That's the simple bit. When we do the calculation in terms of the income statement, the formula that is used, because we now got opening stock and we got closing stock and we bought something in between. So the calculation is just your opening stock plus your purchases. So let me give you an example. I started the month with 200 Rands worth. I now bought another 300 Rand. So I've got 500 Rands worth. But at the end of this period, I've still got closing stock of 100. So then my cost of sales would be the 400. So it's your opening stock plus purchases minus your closing stock. That's how you would calculate it.
Okay, and just out of interest, let's say you have a product that costs you 100 Rand. That's what you buy it for. When you look at let's say you're buying labels and packaging and things, does that go into the cost of the product or into your expenses? Like, is that a stock or an expense?
Yeah. So just as a point to understand is, if I'm selling for a certain price and now I've got my cost of sales and then my expenses, the bottom line right at the bottom, it doesn't matter to the bottom line whether you put it into your cost of sales or your expenses. It's still coming out. So don't panic too much of whether it's cost of sales or expenses. You need to have a look and say, if it's a cost that's directly related to the product that I'm trying to sell, you would generally put it into the cost of sales. And accountants will use terms like, we will treat it as a cost of sale, or we will treat it as an expense. The only reason why we split it out either to cost of sales or expenses is so that we can analyze ourselves to compare our business from one year to the next to itself, or to compare our business to other similar businesses. So if other businesses are treating something as a cost of sales, we want to do the same so we can compare ourselves to that business. Because, as I'm going to talk a little bit later now, is generally we want to see what our GP is, our gross profit percentage. And what you do, the income statements is sales minus cost of sales equals your gross profit. if we take that gross profit number as a percentage of our sales, that gives us the GP percentage. And depending on what we put into the cost of sales, obviously it'll affect it. So if we put it under expenses, which is below the GP, then our GP will be higher. So just to answer your question, I'm going in a long discussion, but briefly, is anything that's related to the actual product that you're selling. So if it's more, so as you said, labels. If you need a label for every single product, then I would add that to your cost of sales. So it's your product plus the label plus the bottle, all of those things, that becomes your cost of sales. And it's every business needs to look at the type of business it is to aim at a certain GP, and that's a crucial number, because some businesses have a higher GP and some have a lower GP. Generally speaking, if it's a high volume business, so if you're selling lots and lots of units of it, so for example, if it's a petrol station where you're selling petrol, or even a business like airtime where there's not lots of units, you can afford a lower GP. So your business, you need to look at it. Are you in a volume business or what we call a margin business? A margin business is one where you have a higher gross profit margin. Okay. And for instance, a restaurant would be a high GP business. They need gross profit percentage of around 60%. So if they take their sales minus the cost of sales, they've got to be left at 60% in order to be paid for all the other expenses. What that means is a salad, let's say you go to a restaurant, you buy a salad, it costs 100 Rand. The cost of that salad can't be more than 40 Rand, so that they're left with 60, and that's a 60% GP, because if you take that GP as a percentage of the sales, that gives them 60%. Other businesses can work on a lower GP if they've got different volumes. Does that answer your question? Have I...
Yes, thank you very much.
Awesome. Any other comments or questions?
David, so by the same measure, discounts would come under cost of sales.
Yeah, so what you would do with your discount is it's not under cost of sales, it's actually reducing the sale amount.
No.
Yeah, so it does affect the GP, but not at the cost of sales level. It's you're reducing your actual sales. Yeah, so generally when people discount, the reason you want to discount is to have more sales. If you're discounting a product and your volume's not going up, then you shouldn't be discounting. The only reason that you would discount is that you bring the price down, but you push the volume up. And hopefully the volume is big enough, the increase in the volume is big enough to compensate for the discount that you're giving. Okay, great. Anything else? Okay, then I'm going to share the screen again. Let me just make this bigger so you can see it. Great. So those are those two videos I've just shown you. So let me just go through this. So just in terms of ratios, it's important that you monitor your business by doing certain ratios. And people get very confused with the ratios and don't understand what they are. Just generally speaking, a ratio is just one number divided by another. You can take any numbers and divide anything by anything. So the example I just gave you now with your GP percentage is to take your gross profit as a percentage of sales. But you can use anything and use a ratio that try and gives you a little bit of insight into your business. Let me give you an example of a weird ratio. So Raymond Ackerman from Pick n Pay used to use a ratio. I'm going to call it the frozen chicken ratio. I don't know what he used to what he called it. But he used to take the sale of frozen chickens and divide it by the sale of other meats. And he used to be able to say whether the economy was expanding or contracting with that ratio. And it sounds a bit crazy, like, how would you do that? Why would that work? Frozen chicken is the cheaper meat. Other expenses is more expensive meat, the other sale of other meats. Now, if I do the cheaper meat by the more expensive meats and I do that ratio, if that number gets bigger, it means that people are spending more money percentage-wise on the cheaper stuff, which is an indication that people have less disposable income, which means that the economy overall is shrinking. And so what he used to do is to look at this and say, let me do that ratio, let me understand what it says, and then this is the important bit. It's not about just calculating the ratio, it's let me make a decision based on that ratio. And when it was dropping, so that people had less disposable income, he used to move more of the cheaper stuff to the front of the store. And when it was the other way around, people had more disposable income, he'd move more of the expensive stuff to the front of the store. So have a look at your business and try and understand and do some kind of ratio. It's anything divided by anything, to see what is happening in the business, and then based on that, how you're going to behave and how you're going to change. And there are many different ratios that one can do of anything. So I would, if I looked at a business, I'd look at all my products and I'd try and do a ratio of my total sales. What percentage is each product to my total sales? And is there a product that is more than all the others? So if you've got an example I looked at of a business the other day was they were selling these pies, and 80% of their sales came from wholesale and only 20% was from retail. But they were spending 90% of their time on the retail. So they're spending 90% of their time to earn only 20% of the income, where 10% of the time was spent on the 80%. And so what you can do is, once you're aware of these things, then decide maybe we don't need the retail side of the business. Maybe we just go wholesale. Maybe the wholesale, and maybe you can't. Maybe the retail is driving the wholesale, but at least it gives you some insight into the business. What you need to look at in terms of ratios is the same way as, let's say, a medical doctor would look at a patient. If you're not feeling well, you'll go to the doctor, and the doctor does maybe 5 things. He looks at your temperature, takes your blood pressure, looks down your throat, looks in your wallet and says cough. Bad joke. But what he's doing is he looks at 5 things. If all of those 5 things are okay within the norms, he kind of says, no, you're okay. If not, if something's out of kilter, then he'll investigate it further. When you're looking at a business, you need to have a look and say, what are the things I'm going to be looking at? What are those ratios, those indicators, and then use that to determine the health of your business. And if you know what the norm is, then you can see whether it's not normal, and then decide what are you going to do about the business. So, very important that whatever business you're in, do some kind of ratio, find some kind of ratio or set of ratios. I say a handful is good. If you can find 5 or 6 very good ratios, then you can immediately look at that and understand what is the business like. So when we spoke about those soccer players and the scoring the goals and how do you know who's winning, the income statement balance sheet gives you the scorecard, but you analyze the scorecard by different ratios. And that's where this financial dashboard comes in. And a dashboard is just about having some of these numbers in the palm of your hand that you can look at it and immediately know if the business is doing well or not. I personally prefer taking those numbers and putting them into graphs, into graphics, because they say a picture paints 1,000 words. You can see a whole lot of information by just a snapshot. So let me give you an example. For instance, you look at Standard Bank. So this was in the financial statements of Standard Bank. They took the entire bank and they reduced it down to 7 ratios, 7 key things that they look at. And let me just talk you through what they've got here. So they've got these ratios, okay? And it's African regions contribution. It's how, from the rest of Africa, how it contributes. That's a target for them. And they wanted that to be bigger than 30%. They'd look at cost to income ratio. What's your cost divided by your income? By the way, banks and insurance companies look at cost to income. Most other businesses look at return on investment, but it's kind of the same kind of thing, just the other way around. Then they look at something called the credit loss, etc., etc. But the interesting thing is that these 3 ratios that they look at is what they determine. This tells them how they're growing. These ratios are linked to growth. These 2 ratios are linked to what they call their resilience, and these 2 are linked to returns. They've taken the entire business. They say, we want to see how we're doing in terms of growth, resilience, and returns, and these ratios will tell us. What they also do is they don't just do the ratios, they know what they're targeting at, what their targets are, and then this happened to be in the first half of 2018, what they actually achieved. But besides that, they have a traffic light indicator to tell you what's good or bad. So that a 5-year-old could look at this and tell you, green, that's good, that's good, that's good. These 2 over here are kind of okay. The red one's a problem. And here's the thing. If we just looked at this, cost to income ratio approaching 50%, generally you'd say, oh, well, this is 57. That is better than 50. Why is it red? And the truth is that this, instead of looking at returns on investment, it's your cost to your income. It's the other way around. So approaching 50% means it should be 50% or lower. In this particular case, a smaller number is better. And that's why whenever you're doing these ratios, it's very nice to use what we call the traffic lights, because you can immediately see that it's a problem that one could confuse this and think, oh, well, that's good because it's bigger than 50. This definitely tells you that it's not. So if a bank like Standard Bank, a huge organization like this, can reduce the whole business down to 7 indicators, whatever business you're in, you can decide what are the key things that you need to look at. What's the most important things that you need to look at? And you can monitor that and make sure that you're achieving it. Let me give you another example. So when COVID first hit in Singapore, they went and they created a dashboard to see what was happening, and they were monitoring a whole lot of things. Let me just zoom into something here rather. So with their dashboard, they could look at, let's say, how many were male, how many were females. And originally, more males were infected than females. They could have a look at the confirmed cases. They could see the average age, what they called local transmission or imported cases. So local transmission, that people caught it in the country. Imported means people arrived with it. They gave a map of the city saying where people contracted it. And here you could see in those early days. Remember, this was even before. This was in January 2020. This was even as it started happening. They started monitoring. This was before we even had it in South Africa. But you could see that they saw that most people contracted it at the Grace Assembly of God and at a private dinner function. So they started realizing that more and more people are contracting it when they get together. So if they could do it on that, if you can create look at your business, understand where did your money come from? Where is it now? Your balance sheet. How's your profits? How are you making a profit? What are your sales, your costs, etc.? You can do that. And then convert that by doing some key ratios, looking at important things that you think are important to your business and convert it into a picture, which is now the dashboard, you can be able to tell exactly what's happening. And when you look at that, you can see and monitor that a lot more carefully. Okay. Any comments or questions with that?
Nothing. Thank you, David.
Okay. Nothing from anyone there.
No.
Okay, great. Another thing that one needs to do is you need to compare, for instance, 1 year or 1 month to the next. And I found that some people struggle with the calculation with this. So let me quickly just run you through this. When you're looking to look at calculate a percentage increase, you look at the difference between the one and the other. So if I've got 1 year and the next, or 1 month and the next, I look at the difference between the two. And then I say, where did I start from? And I divide that number by where I started from. And then you convert it to a percentage by multiplying by 100. And what this does is it gives you the percentage growth. And you need to look at that percentage growth to see how you've grown over time. Okay. Can I get some indication from some of you what type of business you're in, and what do you think are some of the things that you should be looking at? So if anybody wants to share a little bit around your business, and then kind of why you're attending this, what you're hoping to get out of today's session, and have you got it, or is there something else that you'd like to discuss?
I'm happy to chat.
Great. Jody.
So I understand all of this. I do my own taxes. So, I mean, in terms of to hand it into the tax man. So I understand all of this, but I mean, for me, it's more about like, if you clearly can see after 30 years of doing things one way, never worrying about money, and it always came. And now with COVID and other external factors like Ukraine, the war, etc., where there isn't the same financial rewards, it's like, yes, you can say go and get more business or go and, but things take time and not everyone is just going to jump at that. So it's like, when do you realize that maybe you should become an Uber driver, or I don't know. It's like, at what financial point? Or do you say, and I'm talking because of the climate and you in finances, like, do you predict that with Ukraine happening and with COVID, how we should be looking at things? Because I don't think it's as predictable as the charts that we look at.
Yeah. So so here's the dilemma. Let me give you an example. So Tracy mentioned the book Life on the Run. So I wrote a book many years ago based on the Comrades Marathon. I ran a couple of Comrades, and then I learned a lot of lessons through running that apply to life and business in general. And I wrote that in that book. And the one lesson was, and in fact, the book came about because of this. I was running a race, and it was called Omdidam, which is near Pretoria, and I was going up the steep hill. And as I was running, it got steeper and steeper, and I got more and more tired. And to be honest, at one stage, I just wanted to give up. I thought, no, I can't do this.
Yeah.
But I looked up and I saw the top of the hill, and I was pretty close. That gave me the strength to push through. And I pushed till I got to the top, and then it's easy on the way down. And it was much easier, and it was fantastic, and I was glad that I pushed through and I finished the race. But what I started thinking is, how many times in life have I been in a situation where it got harder and harder and harder, and then I gave up and I changed direction. I said, I can't do this. And I think that's kind of what you're asking. And the fact that I could see the top of the hill, I could see that I was nearly there, gave me the strength to push through. And I see this again and again. I see businesses that are failing, and people can't accept that they're failing, and they keep going and hitting their head against the brick wall and putting more and more money in and failing. And it just, they're doing something that's not working, and they keep doing it, and then it fails anyway, and they put effort and money into it where maybe they shouldn't have. On the other hand, I see businesses who are similar to climbing that mountain, who are going through the hardest time, but if they just persevere a little bit more, then they get over the top, and then it becomes easy from then onwards. So I can't give you a kind of an answer, one fits all answer. It is really about every business and about you examining that. But to be honest about it and look at it and say, what are the chances that it's really getting hard now because we're near the top? Yes, we've been through a pandemic for 2 years it's been a disaster. Business hasn't been the same. Now we're just getting through it, and now we get hit by the Russians invading, and that now affects the petrol price, which now affects the cost of all my goods in my business. So it's like, just when I thought it was getting better, it gets worse. And unfortunately, life seems to be like that it gives you a second round, and there might be a third round, but eventually we get through it. What is your business? And it's around going for, Simon Sinek talks about the why. Find your why. Why are you doing something? And then the how. And it's around, if the reason you've got the business is a bigger reason, if there's a need for what you're doing, then there's a chance. A lot of people look at a business and say, well, I know how to do this, I'm going to do it. The question needs to be, what does the market need? And if you can fill that need, and what is that need around is there a problem that my product is solving? What is the problem, and can I solve that problem? And does my product solve that problem? And if it does, it might be worth persevering. But if you are offering something that is no longer required, then you've got an issue. Let me give you another example. So there was a guy many, many years ago, obviously, who made chariots. And he made the best chariots in Europe. And he was known as the best chariot maker. And then cars, they started bringing in cars. And obviously his sales started dropping. And his response to that was, wow, I better improve the way I make my chariots. And so he made even better chariots. And he put more gold in them and made them more fancy. But the market had shifted. And no matter how beautiful his chariots were, and even if he made them better than what they were, he was never going to survive. And his problem was the way he defined his business. So maybe this is the answer to your question, is how are you defining your business? He defined his business as being a chariot maker. So when there was a problem, he just tried to see, how can I make bigger and better chariots? Where maybe if he looked at his business and said, I'm in the transport game, then he would have moved with the times. So, Jody, I don't know what business you do, but it might be worth looking and saying, am I defining what I'm doing too narrowly? And can I broaden that definition and then still provide the product that is required.
Okay.
I don't know if I've answered your question, but yeah, and it's not around trying to find an immediate answer. It's about questioning things, and sometimes the answer comes through the questioning. And when COVID hit, a lot of people started talking about pivoting, and it's around the broader you define it, the more you can so-called pivot. And it's all that pivot is focus. Your focus needs to change from here to here. Can you focus on something even within your own business?
Okay.
Yeah. What business are you in? What do you do?
I'm in the arts. I'm a photographer.
Okay.
And I've lived my passion for 30 years. Never had to concern myself about work coming in. I totally proved myself, by the work. I'm a worker. But with COVID and Ukraine, and I work internationally. So, for example, will there be a third world war? Because that means I won't be able to go to Germany in July. So there are a whole lot of issues that influence what is happening right now.
Okay. While I'm talking to you, I'm trying to pull up a little presentation because there's something else that I want to show you then that is related to this potentially. Let me just see if I can find my slide. Where is this? I'm just trying to see. I gave a presentation recently, and I just want to see if it's on here, because this will, yes, here we go. Okay, so I'm going to pull up, I'm just going to share you with, just based on your question now. Let me just share the screen. And this might be just another way of answering your question. Okay, so this is something I gave a talk at the Graduate School of Business for Cape Town. So just excuse the logos. I wasn't going to bring this in, but I just want to discuss this with you. And I think this relates directly to what you're asking. So here is a mouse that's sitting on top of a bottle with some food in it. The mouse is meant to run around and find the food, but was so lucky that he found this jar of food and he doesn't have to run around again. The food is there. Wow, he's in a very comfortable state. And he starts eating the food. And he doesn't move. He just eats and eats and eats and eats. The problem with this is that after a while, he lands up in this scenario. And now he's eating and eating, and he doesn't realize he's now trapped. Because when he gets to the end of the food, he can't get out of the jar. And he's eaten himself into a state. He's eaten himself into an entrapment. And where this relates maybe to your scenario is that what looks good in the short term could long term be a trap. And if sometimes things come too easy, and maybe you did have things easily, you become too dependent on that, and you've lost the skills to run around and look for different things. And so for your scenario, it sounds like you did have it good, and you did have all the work just coming in. But maybe you've lost that skill of now going and finding different things. And it feels hard now. And change is hard. They say the only person that likes change is a baby with a wet nappy. We don't like change. But maybe this is the time to change. And maybe this is your way. You can go and look for things, and you might find a whole lot of different opportunities that are waiting for you, but it's only by going and looking for it now that you will be able to find those opportunities.
Thank you.
I want to ask you something in return then. Just sitting here now, what are some of those things that you think might be opportunities? If you were advising somebody else, another photographer, what things could they do? And let's say they weren't successful, they were just starting out. What would you tell them to do? Have I lost you guys?
No, Dave, your net is still online.
Okay. All right, let's, maybe she doesn't want to answer that, but anyone else want to discuss their business?
Hello?
Yeah,
Were
Jody.
you asking me a question?
Yes. So I just wanted to ask you, if somebody came to you who was starting out in your area in as a photographer and said, what should I do? How should I go about things? What would you tell them?
Well, firstly, I did tell a younger photographer the other day that you need to, if you're making a lot of money now, you need to learn to save that money, because it's not going to be like that all the time. I've just learned that now. Also, in this day and age, I spoke about looking at NFTs, non-fundable that's something that I can look at, which I don't really understand, and there's a lot of rubbish on there, but people make a lot of money. So it's something to look at. I'm also looking at more corporate work, but that doesn't, because I've always stuck to my passion and what I believe in. So I've never had to do that. So corporate work.
Okay. Can I stop you for a second?
Yeah.
Try to answer this question not about you,
Okay.
about someone else coming into the business. Someone else is about to start. They have no history. So you're talking about saving money and whatever. What would you tell that person to do? So, and I think the NFT thing is great, and I'm also looking at that, and I think it's, but looking at somebody else, what would you do? What would you tell them to do?
Well, I mean, if I'm teaching students, I would never tell them not to be a photographer. But what I would tell them to do is that if you don't have the passion and you don't have the drive, and if you don't have the mentality of it's not 9 to 5, then don't do it. And also, if you aren't an ideas person, and if you're going to sit and wait for things, then it isn't going to happen. So that's what I would tell a young person. I would also tell them to go into more the arts than to photojournalism, because photojournalism is a dying craft. So those are some of the things I would tell them.
Okay. So I would like you to talk to yourself as if you're only getting into this business now, and say, if I was getting into the business now, where would my focus be and what would I do? And how, so you talk about the arts, how could I get into the arts? How could I take my work and present it maybe differently? How could I do it? And one of the avenues, definitely the NFTs. How could I take it and maybe take all my older pictures and redo stuff or put them together in some way? So look at this. When you say, should I give up altogether? Maybe no. But maybe like the chariot makers, don't look at what you're doing narrowly. See if you can broaden it out. And because you've got a name and the expertise in the area, maybe you can offer it with a premium because it's you, etc. So, yeah. So maybe you'd look at it like that.
I will.
Okay.
Thank you.
Great. Thank you. Anyone else want to come in with a little bit around their own business?
Thank you, Dave. No one.
Okay, then let me share one last concept or idea with you. And again, I'm just taking it from another presentation. So this is a presentation I actually gave at the Henley Business School. So I'm running you through all the different business schools. So here's Starbucks, and in fact, there's me sitting in the original Starbucks in Seattle. And when I was there, I was told a very interesting story around Starbucks. But I'll come to that story in a second. But let me ask you, what business is Starbucks in? How do they define their business? And most of you would say coffee. They're in the coffee business. Correct? Starbucks sells coffee. But Howard Schultz, the CEO of Starbucks, says this. He says, we are not in the coffee business serving people. We are in the people business. We just happen to be serving coffee. And you might look at this and say, well, it's the same thing. But it's not. It depends where your focus is on. When you go to Starbucks, the coffee might not be much better than anywhere else. The coffee, might be a little bit better, but maybe not. But when you go, they ask you your name and they write your name down on the cup. And then you're waiting and you don't hear number 785, please come get your coffee. You get, David, your coffee is ready. It's personal. That is their little umbrella that I spoke about before. That's the little trim tab. That's the little change that they do, the shift. Others have started doing that in similar things. You go to VDE and you ask for a coffee and they do a song and dance around it. This is what's important in a business, is where your focus is on. And this is the focus that is on the people. How can you change your business to change what you're focusing on? And they make it clear that it's about the people, not the coffee. When you go into Starbucks, they do stuff to make you feel good about yourself via the coffee. Anyone want to make comments or talk about this?
It's Jody here. For me, Starbucks is really useful if you're in Europe or America and you need the bathroom or you need to use Wi-Fi. They always have somewhere where you can connect to, and no one ever questions you for how long you're sitting there. You can use Starbucks as your office, as well as if you're desperate for the bathroom. Yeah.
And so they're giving you stuff, and I use Starbucks here and I go sit there, and originally I went there and I sat there for free. They don't tell you have to buy the coffee. It's about the people, and then eventually you buy the coffee. Yeah. Yonit?
Yeah, I wanted to ask you, for someone who has started a business but knows nothing about finances and how to run a business from a financial point of view, what would you advise to be the first thing to do, like your first step?
Okay, so through the ORT program, it would be important to go through and get a mentor and get someone who can help you from the financial point of view, just to work out beforehand at your prices, at your product, where your break-even point is. Are you going to make money? Is it a viable business? That's the most important thing before you get going. So it's to have your idea and then to look at your whole business and then decide, is this a viable business from a financial point of view?
Okay, and also, where is the best place, like online, to learn about how, all this accounting, accountantese? Where's the best place to learn about it?
Yeah, so in order to run a business, you don't have to be an accountant. You just need to understand the aspect, are you getting greater returns than what it's costing you? That's the bottom line. At the end of the day, you need to make sure that you're getting more returns than what your costs are. There are many courses out there talking about finance, and they can tell you how to do the accounting and how to be a financial person. Your focus needs to be on the business itself. As long as you understand kind of the basics of the finances, then you can hand that to somebody who can just record it. Accounting is just recording what the business is doing. So rather than spending all your time learning how to record it, you need to spend most of your time learning how to do your business. And business is around three things. It's having a product. It's then being able to sell that product. So it's having the product, having a purchaser, and connecting the two. That's what business is around. You need to spend at least half your time selling the product than just creating it.
All right, thank you very much.
Okay. So I want to play, I'm going to end off with one last video, which gives, it's a very short video that gives an insight into businesses. And really this is, again, on that same trip, what I used to do pre-COVID, and again, it's having to pivot. I used to take students overseas to visit different companies, and we used to get insights from CEOs of different companies. But one of the most interesting ones was not a CEO of a company. In Seattle, there's a fishmonger they sell fish, but part of the stuff that they do is they throw fish around and make it entertaining. And I happened to ask one of the guys who just works there. He doesn't run the business. He's one of the guys who just sells fish. I had to ask him about what he does. And some of the insight that I got just from him was even greater, I think, than some of the CEOs of other businesses. So let me play this just for you, and we'll just quickly go through the lessons that we learned through this. Okay, so let me play this video for you.
Out here in need of customer service? Anybody? Nope. Guys, we back for airline travel and we ship anywhere in the U.S. If you live in Ohio, you can eat fresh seafood too.
So Ryan, what makes this? What business lesson can you tell us? What makes a good job or good? What makes it enjoyable?
Why we are world famous is not because we throw fish. It's because we hang out with people. We try to make people's days. In turn, we sell lots of fish. So it's really about like who we're being and like be interested, not interesting. It's kind of like the idea. Yeah. And And then teamwork. There's a big amount of like respond and acknowledge. Everybody yells it out. It's how we flow. It's how we work. It's how, you know, like you have to know what's being thrown at you, right? You can't just randomly throw stuff at people without them like knowing what it is. So yeah, just our communication. And then just like we come in and we have a morning huddle at the beginning of every morning and at the end of every night, just to kind of like get here in the morning. If you got something on your chest, you gotta get off, so then you can be here, you can be present, right? Because otherwise people always have these conversations going in their head. And if you can acknowledge that conversation and be like, cool, I'm not gonna let you run me today, I'm not gonna be in a bad mood because of that. P.S. I'm never in a bad mood. But yeah, some people need that in the morning, and I think it's good. And then at the end of the night, we have an evening huddle, and that is, how do we do? Do we make our goal today? Like we set a goal and an intention for the morning, and then at the end of the day, we check in and see if we were full of it, or if we were doing it, or what we do. So yeah,
excellent.
I've been here like 3 years, and some of these guys have been here 20 to 30 years.
Wow.
You know? So it's like, it's really like a lot of history in Seattle. Like, these guys know everybody down here. It's like, it's nuts. And like, I know quite a few people, worked here 3 years, but the whole market's like a small family in its own way, which is
Great. Thank you.
Yeah.
Awesome. Thank you.
Yeah, have fun in Seattle. Eat lots, drink lots. There's a lot of fun to be had.
Great.
Yeah.
Awesome.
Okay. So he said quite a bit in that. So let me give you just a little summary of what he said. We try to make people's day in turn. We sell a lot of fish. His focus isn't on just selling fish, it's to make people's day. Be interested, not interesting. Your focus needs to be on the customer. There needs to be teamwork. Teamwork is respond and acknowledge. The group huddle is they plan what they're going to achieve in the morning and they see whether they've achieved it at night. They set a goal. Most people, especially in small businesses, don't set goals. They don't know where they're going to. And then it's be here, be present. Understand, see what you're doing in your business. In this place where this guy was, there are quite a few people selling fish, little businesses selling fish. None of the others throw the fish around. Some people don't like the fact that they throw the fish. They buy from someone else. But they are successful because of what they're doing. And that they're throwing fish. And it's that little umbrella that I spoke about a little bit earlier, right in the beginning. What is your umbrella? How are you doing something different that might just add? So they're taking just selling fish and making it a little bit more entertaining. Okay. Guys, we've covered quite a few different things. And what I did is I showed you a little bit around income statements, balance sheets, which is the scorecard of business. You need to know whether you are making money or not making money. You need a scorecard. You need to know what it's worth. Jody, thanks for your input and your questions and sharing what you do, because again, hopefully through that, everyone could start understanding their own businesses and really maybe to change their own focus. I hope this has been useful for you. I hope it's given you a little bit more insight into it. If I can leave you with one message, it's look at your business, understand who your customer is, and how can you delight your customer, and in turn, they'll delight you with being willing to pay for your services. And maybe what you thought your offering might need to be slightly different, but still something that is solving an issue, solving a problem. Any questions before we end it?
Dave, thank you. I absolutely love the way that you brought in so much behavior economics into finance. And for everyone that did register to join us today, you have just put things into such perspective in terms of, if you understand it, it is not difficult. And if you understand it, there is nothing to fear. So in terms of the balance sheets, the income statements, etc., and the material that you use to demonstrate to us how effective it is if you understand what you're doing is absolutely invaluable. I'd also like to thank Jody, Yonette. Thank you for your participation this morning. That is essentially what Bootcamp is about. We like to hear from you just as much as you like to hear from us. So, David, I thank you as always for your time, sharing your expertise, making us think not only about finance, but about the way we do things, the messaging, and most importantly for me this morning, I would definitely say is look at the why. Look at why you are in business. And given the example that David gave us, you know, of the people selling fish, they're in the business for the people. Starbucks in the business for the people. So I think that's something very, very important for everybody to look at in your own businesses. Before we close off today, we are going to put up one